Welcome back to part 3 on recording business transactions. Next is transaction 7. Smart Touch Learning pays cash for the office supplies they previously purchased from the office supplies store. So they're making a payment on account. When that happens, here's our journal entry. This happened on November 21st. Accounts payable is a liability account. All liabilities decrease on the debit side. So we put $300 on the debit side of accounts payable. And then cash is slightly indented. And all assets, and cash is an asset, gets decreased on the credit side. That's why we credit cash for $300. We write our explanation, paid cash on account, and then we post to update our general ledger. Accounts payable now is a debit on the left-hand side. And notice now, if we take our $500 credit minus our $300 debit, we would have a $200 normal balance on the credit side, showing that we still owe $200 to the office supply store. And then our $300 credit to cash is going to decrease cash on the credit side. Transaction 8 is a collection on account. Remember that Smart Touch Learning a couple transactions ago provided e-learning services to a client. So now the client is going to pay them because when they provided the e-learning services just a couple days ago in early November, the client said, hey, we'll pay you within 1 month. So now they're making that payment to Smart Touch Learning. And the journal entry is, on November 22nd, cash is an asset increasing, so that's a $2,000 debit. Accounts receivable is an asset decreasing. All assets decrease on the credit side, so we have a $2,000 credit. We write our explanation, receive cash on account, and when we post to our T accounts, the $2,000 debit to cash is increasing cash, and accounts receivable gets posted to the credit side. If we did a normal balance for accounts receivable, our $3,000 debit minus our $2,000 credit would show that the client still owes us $1,000, our normal balance on the debit side. Let's now pretend on November 25th, Sheena Bright needs $5,000 and she wants to take it out of the business for her own personal use. So in transaction number 9, we demonstrate an owner cash withdrawal, where Sheena Bright withdraws $5,000 cash from Smart Touch Learning. Here's our journal entry. On the 25th, remember that the withdrawals account always increases on the debit side, so we put that first. Cash is decreasing from Smart Touch Learning. Therefore, cash is decreased with a credit because all assets decreased on the credit side. Our explanation is an owner withdrawal, and once we do the journal entry, we post it and update the cash account. Cash decreases $5,000, and the withdrawals account increases by $5,000. Now let's move to the month of December for Smart Touch Learning. And in December, Smart Touch Learning is going to pay rent on the very first day, December 1st. So when they pay this rent on the first day to cover their rent for the month of December, they're going to record this not as rent expense, but prepaid rent. It's December 1st. They are prepaying their rent for the month of December on the 1st, and it's going to be an asset increasing on the debit side. Notice it's not an expense because prepaid rent is providing us a future economic benefit. It's providing Smart Touch Learning the benefit of having rent for their office space for the month of December. So we're going to debit not rent expense, but prepaid rent an asset for $3,000. We'll credit cash, an asset decreasing on the credit side. The explanation is paid rent in advance. So now when we post, prepaid rent is an asset increasing and cash is an asset decreasing. Transaction 11 is a review of a transaction you already saw in November. Smart Touch Learning is going to pay their employee's salary. When they do this on December 1st, salaries expense is going to increase on the debit side $1,200. Again, think of expenses like a negative equity account. Cash is our credit. All assets decrease on the credit side, and we write our explanation, paid salaries. The next step is we post to update our general ledger. Salaries expense has now increased for the period, and cash has now decreased with a credit. Transaction 12 is a new one for you. On December 1st, Smart Touch Learning is going to purchase a building so they can use it as office space in the future. But they probably don't have $60,000 cash on hand, so instead of paying cash, they are going to record a note payable. Remember from a previous lesson, a note payable is a formal written agreement to pay a certain sum of money in the future, usually with an interest attached to it. So in this case, SmartTouch Learning is going to write a $60,000 promissory note. They're going to give that in exchange for purchasing an office building. When they record this on December 1st, the buildings account is an asset account because it provides a future economic benefit. All assets increase on the debit side. Just like accounts payable, a note payable is a debt, a promise to pay in the future. So we slightly indent notes payable. All liabilities increase on the credit side. We write the explanation, purchase of a building with a note, and then we post these to update our general ledger. Buildings, an asset account increases on the debit side. Note payable, a liability account increases on the credit side. Transaction 13 is a variation from the very first transaction where Sheena Bright contributed $30,000 cash to start SmartTouch Learning. Most of the time, an owner will contribute cash, but an owner can also contribute other types of property. And this is what happens here, where Sheena Bright contributes her own furniture to put in the office of SmartTouch Learning. Here's the journal entry for this transaction. The date, let's say, is December 2nd. The furniture account for SmartTouch Learning is increased with a debit because it's an asset. And the capital account increases $18,000 on the credit side because it is an owner contribution. Once the journal entry is complete, we can now post and update the accounts. Furniture, debit of $18,000, and the Bright capital account, a credit of $18,000. Transaction 14 is recording an accrued liability. And just a review of the term accrued, that means an expense has been incurred, an expense has been charged to SmartTouch Learning, but they just haven't paid it yet. So in this transaction, SmartTouch Learning receives their utilities bill for December, and they receive this on December 15th. To record this accrued liability, we do record the expense, even though we haven't paid it yet, because we're following the matching principle saying that we record expenses when they've been incurred. Therefore, expenses always increase on the debit side. $100 goes to utilities expense on the debit side. Utilities payable, we owe $100 to the utility company. Therefore, all liabilities increase on the credit side. Therefore, utilities payable is credited for $100. We write the explanation, accrued utility liability, and then we update our general ledger. Expenses increase, utilities expense on the debit side. Utilities payable increases on the credit side, a liability. SmartTouch Learning pays their employees' salary twice a month. So one more time in transaction 15, this is what they do. They pay their employees' salary. So on December 15th, this is just a review from just a couple transactions ago. Salaries expense increases on the debit side and expense. Cash and asset decreases on the credit side. We write our explanation paid salaries. And we update our salaries expense. Notice the salaries expense has been increasing throughout November and December, and cash decreases with a credit. Transaction 16 is our first example of an unearned revenue. On December 22nd, a law firm hires SmartTouch Learning to perform e-learning services for them in the future. And on December 22nd, they're going to pay SmartTouch Learning in advance $600. Now, SmartTouch Learning owes a liability to the law firm. They don't owe them cash, but they owe them those e-learning services. So in recording this transaction on December 21st, cash is an asset increasing for SmartTouch Learning because they just received the $600 cash. But the unearned revenue account is a liability account. SmartTouch Learning owes the law firm those e-learning services. So we cannot record a revenue that increases equity now. We only record a revenue when SmartTouch Learning earns that revenue when they perform the services. Therefore, unearned revenue is a liability. Liabilities increase on the credit side. Therefore, we have a $600 credit to unearned revenue. We write the explanation, collected cash for future services, and we update our cash and unearned revenue accounts in the general ledger. Transaction 17 is our last transaction for the month of December, and a review of one you've seen already. On December 28th, SmartTouch Learning performs $8,000 worth of e-learning training services for a client, and that client will pay Smart Touch Learning immediately on the 28th. So when we record the journal entry, cash is an asset, increasing on the debit side. So that will be our first account, $8,000 debit. And unlike our last transaction, Smart Touch Learning did earn this revenue. So we don't do anything with unearned revenue, a liability account. We record the equity account service revenue, and that increases equity, $8,000 on the credit side. We write the explanation, perform services, and receive cash. And then we post. We transfer and update cash and service revenue to the general ledger. This concludes part 3, and when you come back for part 4, it will be our final part on recording transactions.